Welcome, future CPAs. If you're a Gen Z accountancy student gearing up for the LECPA, you are in the exact right place. This explainer isn't your standard, dry textbook taxation lecture. No way. Consider this your ultimate cheat code. We're designing this session specifically to hack your brain for a 3-year retention span. That's right, we want this info locked into your long-term memory so you can absolutely crush the taxation part of the Philippine board exams, even if you're just in your second or third year of college right now. So let's get into it. Here's our LECPA Mastery Roadmap. We'll be covering 1. Hacking the LECPA brain. 2. Royalties, inside versus outside. 3. The windfall profits tax. 4. Deadlines, the 60-day rule. 5. The strict no refund rule. And 6. Rapid-fire bullet review. Setting up these mental folders right now is going to prime your brain to file all this complex Philippine tax data perfectly. Section 1. Hacking the LECPA brain. Look, the Philippine tax code is absolutely massive, and trying to memorize it like a phone book, that basically guarantees failure. But here's the thing. Your brain loves patterns, and it thrives on active recall. So we're chunking these dense mining tax laws into bite-sized pieces. Notice the stark white backgrounds? That's totally intentional. We're stripping away all the visual clutter so your brain can basically take a high-definition mental screenshot of this data. Section 2. Royalties, inside versus outside. So when it comes to mining in the Philippines, location literally dictates your tax reality. It's like a geographic dividing line. If the operation is inside a mineral reservation, the rule is absolute. It's a flat rate of 5% of the gross output of the extracted minerals. Super simple, right? But if you're outside a mineral reservation, you're looking at a complex margin-based sliding scale that ranges from 1% to 5%. This scale is based on the ratio of income from metallic mining operations to gross output. So create the spatial memory anchor right now. Inside equals flat, outside equals sliding scale. Let's break down that sliding scale for those outside operations. Now, don't just brute force memorize the numbers, look for the pattern. The margin, which is that income to gross output ratio we just mentioned, dictates the rate. Look at how it climbs. For every 15% jump in the margin bracket, the royalty rate climbs by exactly 1%. Over 0 up to 15%, that's 1%. Over 15 up to 30%, that's 2%. And it keeps stepping up until it caps out at 5% for margins over 60%. Just lock that 15-to-1 rule right into your mind. But wait, what happens when things don't fit perfectly? Okay, pay attention, because this is a classic LECPA trap. Examiners absolutely love to test edge cases. What if the mining operation operates at a loss, meaning the margin is 0% or even less? Do they just escape paying the royalty entirely? No way. The law imposes a minimum royalty of 0.1%. That's 0.1% of the gross output. Definitely highlight this in your mental notes so you don't get caught off guard on exam day. Section 3. The windfall profits tax. Think of the windfall profits tax as this extra layer of complexity stacked right on top of the royalties. It's an additional progressive tax. But, and this is huge, look at the base. While royalties are generally based on gross output, this windfall tax is based on the net income from metallic mining operations. And here is the absolute most testable part of this entire concept. It is not deductible from taxable income. For standard corporate income tax purposes, you literally cannot deduct this windfall tax. Seriously, put mental red stars around that fact. So let's look at how this progressive tax is structured. Once again, we're pattern hunting. Notice how the margin triggers start much higher here, beginning at 30%. Contrast these rates, which run from 1% all the way up to a massive 10%, against the 1% to 5% royalty rates we just looked at. The jump is way steeper. For instance, over 40% up to 55% triggers a 3% rate, while anything over 75% triggers that 10% tax on net income. Just ask your brain to note this distinct mathematical progression. Section 4. Deadlines and the 60-day rule. Let's shift gears from math to procedural compliance, because let's be real, on the board exams, missing a deadline is just as bad as getting the math wrong. I need you to burn this number into your visual memory bank right now. 60. When dealing with locally extracted metallic minerals, quarterly returns and royalty payments are due within 60 days after the end of the calendar quarter when the products were removed. Actually, let's repeat that for emphasis. 60 days, not 20, not 30, 60. Let's view this compliance chronologically to really make it stick. Step 1 is that 60-day rule we just memorized for the quarterly return and royalty payment. And remember, the taxpayer has to file a bond approximating the royalty due on those removals. Step 2, you must file a final annual royalty adjustment return to settle any balances from the preceding year. Finally, Step 3, and don't confuse the windfall profits tax deadline with the 60-day royalty rule. The windfall tax follows the standard income tax rhythm. It's due by April 15th or the 15th day of the 4th month following the close of the fiscal year. Section 5, the strict no refund rule. Okay, I want you to pause for a second and use your active recall. Based on your general knowledge of VAT, where exports are often zero-rated, what do you think happens with special mining taxes in the Philippines when the product is shipped overseas? Do you get a refund or a tax credit? Go ahead, take a guess. Well, here is the harsh reality of the Philippine tax code. The rule is strictly non-refundable and non-creditable. Statutory rules explicitly prohibit any refund or credit of mining royalties, and mineral excise taxes too, with the exception of coal and coke, even if the minerals are eventually exported. So unlike that, these special mining levies stick to the product forever, no matter what ocean they cross. Section 6, Rapid Fire Bullet Review. Let's do this. We've covered the core concepts, and now it's time to take that high-definition mental screenshot. Ready? Inside mineral reservations, flat 5% of gross output. Outside reservations, 1% to 5% sliding scale on margin, with that tricky 0.1% minimum catch. Windfall profits tax, 1% to 10% progressive tax calculated on net income. And remember, it is never deductible. Deadlines, your magic number is 60 days after the quarter end for quarterly returns. And finally, the export rule, absolutely no refunds and no tax credits. You just systematically digested a highly complex area of the Philippine tax code. By using visual contrast, chunking the data, and hunting for mathematical patterns, you've completely hacked your brain for long-term retention. So, my final question to you is this. How are you going to apply this exact same pattern recognition strategy to conquer the rest of your LCPA review materials? Grab these cheat codes, stay laser-focused, and go crush those exams.